Good morning and welcome to Core Finance. I'm Matt Brown. I'm joined by Alessio Rastani. Good morning to you, Alessio.
Thanks very much. Good to be here. Thanks.
We're going to start off with the S&P.
Well, here's the thing. Everything I'm going to say today could easily apply to the Dow, could apply to the FTSE UK 100, to the German DAX, because predominantly we're seeing the same patterns. What I've shown here on this chart, which is quite interesting, is going back at least for, what is that? It looks to me like about a year, and seeing how volatility has acted on price. So as a sort of a leading indicator, in fact. And notice what I'm showing here in this chart is when volatility drops, like it is now. I mean, look at this, Matt, and I want to show your viewers. Notice how the volatility has dropped below its previous levels for the whole year. I mean, it's gone below that red line that I've just drawn there. And notice that whenever volatility gets this low, notice what happens to the price, to the stock market, in other words. The market usually responds by a correction. That first arrow you see there on the left, the volatility dropped quite massively in August of last year, which resulted in a multi-month, at least 2 to 3 month correction in the stock markets. Dropped, but I think it was about 3 to 4% drop there. What this volatility is telling us, and whenever we get these low volatility readings, it's warning us that we could be due for a potential correction. How big that correction is going to be, we don't know. I mean, it could be something as small as a couple of percent, 2%, but maybe some. I think what seems to happen, though, is about a 3 to 5% correction is probably more common. I personally think, given the fact that we've rallied this high, we've had a single correction for at least a couple of months now. I think more likely I'm looking for a 3% to 5% correction. That would bring the S&P down to, at a minimum, at 2,500, but we may even go below 2,500 and test previous support at 2,480. So those are interesting things. So folks who are watching us right now, certainly look for any sort of divergences, look for some setups to potentially get short on the stock markets. In fact, I'm going to talk about that with our own premium members on Leading Trader. There's something called the Halloween effect. And the Halloween effect occurs around about this time of year. In fact, as we get close to the end of October, or Halloween, in other words. And that effect simply is this. Usually you see weakness or a drop in the stock market. Again, it could be 3% or 5%, something along those lines. But that usually is a buying opportunity, because the Halloween effect is being studied for going back decades, over 50 years. And it says that any weakness in the months of October to the first half of November can be used and should be used as an opportunity to get long, because the next period from November to December is very strong. And then you got the Santa Claus rally coming up towards the second half of December. So I would suggest to folks who are watching right now, sure, it's okay to get bearish now, but when the drop happens, when you see a correction, be ready to get long, because the Halloween effect, which has been, again, consistent throughout decades, will probably step in, and we should see a rally back again to retest. I think I would not be surprised to see 2,600 by the end of this year. So again, any weakness in the next could be happening in the next few days, or maybe by the end of the month. Use it as an opportunity to get long.
Fantastic. And another trade as well is buying the volatility.
Right. Yeah, absolutely.
Well, buy the VIX.
Absolutely, yeah.
Alessio, thank you very much for joining us today.
Thanks a lot.
Alright guys, thank you very much for watching this video. If you like this video, then please remember to give it a thumbs up. And if you want to see more videos like this in the future, please remember to subscribe to our channel. You can also find me on my website, which is leadingtrader.com. Thanks very much.